Hi everyone, I'm Mario Rodriguez, Wealthion's executive producer. It's hard to believe it's already been 6 months since we launched Rise Up. During that time, our hosts, Terry Carlson and Joe Duran from Rise Growth, together with the expert wealth management teams at Bleakley, now One Point BFG Wealth Partners, and Grimes and Company, have shared powerful insights on navigating markets, managing your portfolio, and planning for life. Today, we've gathered the very best of those conversations into one special show with practical advice you can put into action right now. And remember, you can connect with the brilliant teams at OnePoint and Grimes for a free one-on-one portfolio review at wealthion.com/free. Let's watch, enjoy.
People need to think long term. These short market swings are massive. The market feels schizophrenic. Your instinct will always say you need to act fast. You see the market going up 3,000 points, you want to jump in because you think that tomorrow is going to be the same. But typically, that's the worst move possible. You look like a hero one day, you end up a zero the next. Short term investors have gotten caught up day in and day out with various sorts of FOMO, whether it be the meme stocks, the tech trades, Magnificent Seven. They're searching for the quick win. So, what I would say is, number one, absolutely think long term. But number two, revisit your plan that you've created. Talk it out. Is this a logical or irrational move? What Joe said earlier, it really speaks to what's happening right now. 2008, that was the mortgage crisis, dot-com bubble. That was obviously, with all the tech stocks there. This is a reversible risk, and it changes like that. So it's really hard to see clients go in all at once, get the quick buck, and then overnight the market goes down 1,000 points.
And Todd, I'd add one thing just to add some color here. It matters where you are, right? Like if you're still accumulating assets and you're still not in retirement, these setbacks allow you to buy and not be as concerned. If you're using your principal to live, you don't want a dollar cost average out in a declining market. So I think your plan has to be different if you're retired versus if you're not. And having a safety net that gives you 3 to 5 years so that you don't have to tap into it. Terry, as a CFP, I know you talk about this a lot. It's the key. Like you have to adjust your thinking. Now, everyone needs to invest for growth because we're all living for a really long time. But mental accounting for most human beings is how you get through this mess. Like you have to be able to say, I have 5 years or 10 years or whatever's the right amount of time safely in the bank and in bonds and in cash. And what happens now doesn't matter because I have 5 years, and it's very few 5 year periods where you've been underwater. And so again, and you can also own stocks that have dividends. You can mix your portfolio allocation within stocks to have a very different outcome. I know both of you are very big proponents of being very cautious in the way you invest in stocks, so you're not overly exposed to what happens with the Mag 7 or any one area. Maybe talk a little bit, Ben. I'd love to hear just on the. By the way, Todd, I don't think you said your third thing, so let's make sure we hear that.
You stole my thunder. That is actually what I was going to say. Is get your portfolio as a bucket system. You have your short term, you have your intermediate term, you have your long term. And I don't need to repeat what you just said, but that's exactly right. Point to your cash as your short term buckets. Don't sell equities to fund your living expenses right now.
It all comes down to time horizon. And time horizon is when do you need your money back? And it doesn't really have a lot to do with your age. It has to do with what's coming up for expenditures, what's the likelihood that you're going to have to tap that portfolio. So whether you're 20 years old or you're 60 years old, if you're going to need money in the next 6 months to a year, that money really you should have on the sidelines. You should be considering high yield money markets, savings accounts, CDs, things like that, where you can easily access. You don't have to worry about market volatility. Volatility is your enemy in the short run. Volatility is your friend in the long run. So anyone that has a longer term time horizon, you're talking younger people in their 401ks, people that are never going to outlive their accounts. They should be invested for growth, and then it's everything in between. You have somebody that's thinking about tapping their retirement account sometime in the next couple of years. I mean, you need a balanced portfolio. You need a balanced portfolio that is exposed to different asset classes, so that when there's market volatility or whatever the market's giving you, you always have a place to go, a place to take from out of the account. And an advisor can help you with that, help make those decisions, help you with your allocation. But like Todd was saying, in general, the decisions should be made up front. The decisions should be made up front with what's going on with your time horizon and really what's the big macro backdrop. Right now, the macro backdrop, there's a lot of uncertainty. I don't like seeing some things I'm seeing right now, like where bond yields are. But at the same time, you got to think that the base case is still very safe. And so, sticking with whatever your plan was a week ago, I think makes sense this week too.
It's never been more important to be deeply diversified, not only across asset class, across geography, across manager, but also by introducing alternative assets, private assets, hard assets like metals, these non-correlated assets that are going to provide those cushion for volatile times. And as long as clients have their liquidity planning met for the next several years, it matters a little less, although it makes us uneasy as well when we see market volatility. It matters a little less what happens in the interim if we're not looking to sell those assets that are going up and down to meet liquidity needs today.
If stocks are at all-time highs and bonds are yielding 5%, then it probably makes sense to take some money out of your stocks that have done really well and put it into some bonds. And also, same thing the other way. I mean, you go back into April, if stocks go into a correction territory and bonds rally, which means the yields go down, there's a flight to safety. And that's probably a good time to maybe take some money out of fixed income and put it back into stocks.
And just to be clear, Kevin, you're not recommending you time the market. You're just saying, look, if your allocation, if you originally were at 50-50 just 6 weeks ago, and the S&P 500 has gone up 24%, your 50% in equity is now maybe, and assuming the bond market has been flat, your 50% in equity is now as much as 62% versus 34%, 38% in fixed income. So your allocation by itself is now much riskier. You've enjoyed the ride. And so the easy move to do is to reshift your portfolio away from the asset class that has done poorly or from the thing that's done well and go to the thing that's done poorly. In a dip, the reverse would be true. The S&P 500 had fallen 20%, which means that your 50% allocation in stocks was now 40%, which means you had 60% in bonds. And you should probably at the dip, instead of putting cash to work, you just shift back to your target allocation. And that's a very non-timing way to be disciplined. A good advisor would automatically do this for you, rebalance your portfolios. But that's a good way to think about it, right?
It's the oldest trick in the book, Joe. It's called rebalancing, and it goes hand in hand with having diversification. So it's just that. It's just simply rebalancing, just like you said. And by the way, nice job with the quick math there. But look, honestly, rebalancing works best at market extremes, right? Because markets can trend for a long time and things can go for a long time. But when you get to these extreme moves or these very quick moves, like Joe was just saying, it could really be presenting an investor with a good opportunity to rebalance back to a target allocation. So remember what your plan is, remember what the target is, and don't be shy to get back to it when the portfolio skews too far from what was your original.
The market and your success isn't about catching tops and bottoms. That's not the issue. It would be better to make a more efficient trade. What I would probably be doing, I would not be all in here thinking that, oh yeah, the market's recovered, everything's great. A lot of times the biggest increases in the market in the short period of time are during bear markets, not bull markets. With that said though, if I got out, now it's very uncomfortable because now you're asking yourself, Is this 5,600 and change going to 6,000? Or are we going to go back to 5,300 and nobody knows? So I would be on a monthly basis, kind of working my way back in to an appropriate allocation that fits your plan, with the idea that if we see 5,300, I'd accelerate a couple months. If I saw 5,200, I'd accelerate a couple months. And if I got to 5,000, sort of that previous low, I would probably get myself back, to where I was. And that's how I'd be viewing it. Working my way, nibble, nibble, nibble. And then if we get those pullbacks, I would be accelerating those pullbacks. The problem is emotionally, when you get those pullbacks and those opportunities, that's when you're going to be most afraid. So the more afraid you get, the more you should be buying. And that's how I would be viewing that.
It's very contradictory, of course, because if we were to go back to 5,000, if we were to drop, I thought we were going to hit 4,800, the news will be so bleak. The whole world will tell you it's going down to 4,000, as we know when we were at 5,000. So the problem is that nobody rings the bell at the bottom. Like what happens is at the bottom, it feels like you're on your way to lower lows. I don't know of a low where that's not true. You hit new lows, everyone will tell you why it's going down another 10 to 20%, and you should get out now. And you just have to do the opposite of what your feelings are telling you and what the whole world is doing. You make your most money, as Warren Buffett has said repeatedly, by doing the opposite of what the biggest crowd is doing. So right now, I think we're in that very important testing zone. We're right at the zone where this market will probably start to question where we are. We certainly are seeing a big separation in international stocks, big separation in value stocks internationally, and certainly within our own US, certain sectors doing much better than others. So I think, again, trying to not make any bold or heroic moves in these times. And again, I think also stepping your way in, usually on down periods rather than up periods. But don't be chasing the up here, because you might be back at 4,800, 5,000, 5,200. And, that 10% is going to feel really bad if you bought right now.
So buying on the dip, I know is sort of a term, and it's a quip, and it's people do it, but it's better to buy things when they're down. And therefore, we like to tell our clients that don't be afraid of a down market. Don't be afraid of a bear market, because usually when you look out over a longer term time horizon, those are the best times to be buying stocks. When you're buying the S&P 500, to Joe's point about valuations, we're trading now almost 23 times 2025 earnings estimates, which historically speaking is in the upper echelon of valuations. Well, that implies that your future 10-year return is going to be lower. If you bought the S&P when it was trading at 15 times or in the past, well, your future returns are much greater. So view pullbacks in the market as being able to buy things cheaper, just as you would go to Walmart to buy things cheaper than somewhere else.
I would not sell unless you have a plan to buy, right? I mean, the biggest mistake that I see people make, and you look at these Dalbar studies. These are these studies about like what did the indices do versus what did the average client or the average person invested in these indices do, and there's a huge discrepancy in returns. And the reason is that people are tempted to sell, and they do sell, and they might feel good for a week or two, but then they get left in the dust because they don't have a plan to buy. So I would say, if you were ever thinking about reducing, you're scared or you're doing something in your portfolio, you got to make sure you have some plan of what you're going to do and what's going to make you think ahead of time, what's going to make you want to get back in. And it can't just be to the downside, because the market may not go down. The market may just bounce and go straight up. So you need to have a plan. You have a plan ahead of time of what you're going to do. Go into the battle with a battle plan, what you're going to do in either situation. And that's what we try to do. We try to have that plan built and then follow the plan. Nothing's perfect. But the net effect is to be able to reduce volatility and to provide liquidity during some tough times.
Well, first and foremost, when something happens, you need to know who's responsible for what. And so if something happened to me, who needs to make decisions? Who has the latitude and the discretion to make those decisions? And in fact, does everybody know that that person has the right to make those decisions? My wife and I went down on a plane unexpectedly. Knock on wood, that never happens. Who makes the decisions? So thinking about not just in your personal life, but your work life as well. If something happened to my spouse, who's accountable for paying the bills? She does everything in our house. I'm almost useless without her. How would that work? And so again, if there's a fire, who's responsible for grabbing what? So being very accountable as to who in the chain of command makes decisions and what discretion do they have to make decisions. For example, how does money get taken out of a bank account if the person who typically takes the money out isn't there? What happens if they can't write checks or wire money for whatever reason? These are very simple things to think about. What would happen if something happened to me or to our home? Who would be responsible and what are they responsible for?
Yeah, Joe, I just want to add to that pragmatically, that's really making sure all your documents are up to date. And that's really power of attorney, making sure you've assigned a financial and medical power of attorney to the people that you trust. And, there's no better day to do that than today because we never know what tomorrow's going to bring. And then the other component is healthcare directives, really including advanced directives for any medical emergencies. Because if your house is on fire, you certainly could be in a certain area where you need health care as well. And unless you have that documented, they can't do much. And then making sure, as Scott said, your will and your trusts are clearly reflecting your current beneficiaries. And I can tell you, Joe and Scott, my husband and I, over 31 years of marriage, we moved 8 times during that time with 3 young children. And every time we moved, our first priority was to make sure our will and trust documents were updated and they really reflected what we needed in the new state that we were in.
I mean, people have as trustees of their will, people they're not even friends with anymore. So again, this is just basic hygiene. Obviously, having an advisor, Scott, very helpful in keeping you like that's what an advisor does, right? Help identify who's accountable and be really a moderator to make sure, hey, this is what so and so wants to have done, right?
Yeah, for sure. We talk about that a lot in our practice. Unfortunately, we meet a lot of people after the fact, or I might be working with a client who's got parents who, the planning should have been done 10 or 20 years ago and it never was. So I've seen a lot of, bad outcomes, if you will, because the planning wasn't done. So we got a lot of experience with that.
And again, with aging parents, I know that we're going to have a whole show dedicated to that topic, but having accountability for who's responsible for our aging parents, for making decisions on their behalf should something bad happen, because again, it's the kind of thing that typically gets ignored.
Yeah, Scott, I think about what you said too. There's a lot of people in our lives that are helping advising, right? But do we have an emergency contact list, for example, right? You talked about your friend running out of your house. Do you have the phone number for your advisors, your accountants, your attorneys, your insurance agents? Do you have all that handy? And if you can't access it, can someone have it? Like, we need an emergency contact list. And then we also need to make sure that we have all of our documents in a safe place. When you only have 10 minutes to get out of your house, make sure you have a safety security box, make sure all your clear documents are in there, and that after the fire, hopefully you can go back and access those original documents.
Just a simple one, but I don't think people think about enough, is that all assets are not equal, meaning that a qualified asset, for example, is going to be taxed ultimately. A non-qualified asset isn't. If assets have low basis or big capital gains, that asset isn't equal to an asset that has lower capital gains. So you want to be very, very careful that you're analyzing all of the assets, whether they're qualified or non-qualified. And what the ownership is. So as you help your clients sort of, divide up assets. So I think that's really, really important. And also try to take some of the emotion out, because divorce is a very emotional, I don't even want to use the word exercise, because it's really more of like a traumatic, experience, for everyone. And so I think having a professional that can be calm, and sort of not emotional about helping people make decisions, is really, really important. We help clients all the time. Oftentimes, we kind of pride ourselves that we will typically keep both clients. We have a couple, they get divorced, and we typically keep the husband and wife because, one, we don't want to take sides, but what we really try to do is encourage people to try to go through that process, as civilly as possible, because in the end, when it's over, especially if there's children involved, you want to be in a situation, where everybody, can actually put it all back together eventually, and that's really, really important. So we really try to counsel our clients. We have a life coach on staff who spends a fair amount of time in those conversations, because divorce is a traumatic experience, and trying to explain the benefit of trying to do that exercise, going through that process in a civil and reasonable way. And it's not about winning, because nobody really wins, but it's about how do we go forward, going forward, and actually try to live a happy life for them, for the other spouse, and for their children.
Liquidity is having money on hand, the safety net. We talk a lot about investing on this show, but one of the things we don't talk about is the importance of liquidity. And lots of asset allocation will talk about equities and fixed income and assets that are illiquid, like alternative investments. The reality is, when you have a crisis, cash is king. And by cash, I mean money you can get to. So it could be on in your savings account, can be in the form of actual cash. But in the US, we're very, very comfortable with debt. We often underappreciate liquidity. So one of the things I know, Scott, you talk about with all your clients is, how much money do you need? And having enough of a reserve. Imagine if your house burned down and you don't get your payment, because for many people in California, myself included, fire insurance was canceled. It simply wasn't offered because the state wouldn't allow the insurance companies to charge what they needed to charge to protect themselves. So we're all on a state level, what's called the California Fair Plan. But what happens if they take 6 months to pay out? And I have to live in a house and I have to support my family. What if my business is at home and I now can't function? So I always say to people, have a big enough reserve to withstand almost anything, at least 6 months if you can afford it, ideally a year, so that you know it's there and it needs to be accessible by not just you, but everyone in your family who might need it in a case of an emergency. So liquidity, often underappreciated until it's too late.
Yeah, 100% agree with that. 6 to 12 months is part of every financial plan we have. Money in the bank. We're not worried about return. We're not worried about, investing that money. We just want to make sure that money is there and available in the event that you are running out of your house and you're waiting on an insurance company, that, you can pay the rent or whatever it is that you've got to do, right, for your new, sort of temporary circumstance, for sure.
And this is a case too where you should have some cash on hand, right? Because some of the time machines, some of the cash distributions machines, they just won't work in some cases.
My time machine never works, Terry. I can't seem to get it. I try. I still every day get up a day older.
Does it ever? I was going to say it never works, Joe, or it doesn't often work? Because
No, it does. It works in one direction. Yeah.
Yeah. Right. Exactly.
But I do think having cash on hand, so you've got kids, you've got to get things done. Somebody's got to eat. Having that on hand, not a lot, but enough to get you through maybe 3 to 5 days in case needed, I think is important.
And when you look at sort of the wealth accumulation life cycle of individuals, it tends to peak in the 55 to 65 period when earnings typically maximize, saving maximizes, and then they're building it for retirement, and then they get depleted over the course of retirement. So it's not just 80% of all stocks that age 55 and up owns. It's actually 80% of everything, just because that's when people tend to have their most significant asset base. That being said, it is important for folks to continue to own stocks when they're entering retirement and in retirement. There used to be this perception that as soon as you retire, you have to put everything into bonds or into the bank and stop earning. But listen, we expect, we want our clients and expect our clients to have long, healthy lives, even once they're in retirement. Part of the reason why people save to retire is so they can have more interesting lives post-retirement. You can, life expectancies, you can be retired for 15, 20, 30 years. And so if you're talking that time horizon, of course you should have an equity component to what you're doing. But then coming back to our initial point we talked about on this call is that you want to have that appropriate liquidity for the short-term stuff so that you can own the equities for the long term, but you still have that liquidity buffer for that 6 to 12 months of cash needs. So you're not forced to transact in a market that might be volatile.
And Emily, you're working with retired clients. What are your thoughts?
Yeah, I agree with Ben. It's funny. Sometimes we'll have people retire, and one of the first things they want to talk about is, well, okay, where's my retirement portfolio? What does that look like? And often the retirement portfolio looks exactly like their current portfolio. Again, we might make tweaks. We might stop reinvesting interest and dividends and have those pay out, or depending on their allocation, maybe we will dial back the stock a little bit. But if you've got a multi-decade long time period to plan for, there is room for risk in the portfolio, and we do need that long-term capital appreciation that will help the portfolio continue to grow even as they're taking distributions. So I think once you walk through that with clients and explain the different pieces of the portfolio, what they're supposed to do, what risk can mean, and how we'll structure those distributions, they do have a much better understanding of what to expect, but also a much better, a higher comfort level with potential volatility and understanding, well, where does this fit into the portfolio?
We, again, are very comfortable taking on debt as a nation. Lots of people have credit card debt. Lots of people have massive mortgages. And these are strategic decisions that debt allows you to enjoy today what you have not yet earned.
Right.
And that's great unless something happens to stop you from earning. And so this is really more of a cautionary tale to me and to everyone. Make sure that you're not taking on so much debt to enjoy life today that you make somebody in your family's life a complete misery if you're not able to pay it off. And you see this often with athletes and celebrities who've taken on massive amounts of debt. Something happens to them, they stop getting work, whatever ends up happening, and now they end up having to go bankrupt because they were living a lifestyle they could not afford today. So again, I'm a huge believer in investing in yourself. I'm a huge believer in investing to enjoy life more, but keep it within moderation. Again, imagine how you'll service that debt if something goes wrong. And often we have personal lines of business of debt that we guarantee personally for our business. And if something happens to us, our family is now left with this massive line of debt that might not be able to fund because maybe if there's provisions in it, if something happens to you, it has to get paid off immediately. So not knowing not just the debt, but what are the terms of the debt? What happens that would cause it to get called back or not renewed? And so I think you want to be very careful when you take on debt. Again, the banks make it very easy and it makes life a lot nicer, but it needs to be within constraints, even with your cars, with everything else you're borrowing money on, even having an itemized list of what do we owe to whom, and making sure that you have that on top. And by the way, it's really important for transparency and for your friends and family to know, okay, these bills still have to get paid, because the worst thing that can happen is you just don't catch it and suddenly you get a foreclosure on something.
Right.
That's right. The other thing, Joe, we haven't really talked about is just evaluating all of your insurance policies and making sure you understand all the riders on those policies as well as a part of this plan, so you know where your liquidity stands.
When you think about indebtedness, by the way, there's on-balance sheet debt, which means things you know about, mortgages, car payments, etc. And then there's off-balance sheet debt. It could be that you're supporting your brother-in-law or you're supporting your cousin, and those liabilities are still a responsibility. Now they don't have the legal teeth of a liability, but there might be payments to former spouses. Fortunately, I only have one wife, but there are those commitments that you have that are not necessarily on a balance sheet, that a good advisor will help you itemize. Hey, what liabilities do you have that are not a traditional debt, but are still a requirement and a responsibility that you have as a family or as an individual to make sure that you take care of that?
So I look at retirement from the perspective of when do I retire, the best time to retire, really two ways. Number one is sort of the math, right? So if Sarah were a client of our firms, we would sit down and we would take a look at what her spend rate is, how much money does she have, her time horizon, how old is she, what's her potential life expectancy, inflation, Social Security. We'd figure all that out. And we'd figure out first and foremost, just numerically, does she have enough money to get her through her retirement years reasonably well? And then the second thing, though, that I would talk to Sarah about as for my client is, how does she feel about not working, and where is she in her career, and does she like working, and does she get satisfaction out of it? I've had a couple of clients over the years that have retired too early, and it's been detrimental to them. So it's not just about that, right? Maybe, having a purpose, having something that engages you, that you like to do. So those are the two things that I talk to my clients about. Do you like working? We get this idea in our head, I'm going to be 65, I've got to retire. Well, if you hate what you're doing, like I've got plenty of clients, if they've got enough money and I say, do you love what you're doing? If the answer is that, yeah, I really like it, I really get a jazz out of it, then I'll tell them, well, stop working because you've got enough. But if they do like it, why not? Maybe you work a little bit less. So I don't know what the answer for Sarah would be, but those are the two things I'd focus on. How do I feel about going to work every day? And how much do I have? How much do I spend? And sort of have somebody like Jeff down the street maybe help her do the math.
Jeff, do you have any comments for your neighbor, Sarah?
I do. I would say the beaches here are great, so you should retire yesterday. No, all joking aside, I think there is a great deal of difference between financial independence and retirement. And so the first question I would ask is, are you telling me that you are financially independent in 3 to 7 years? And if so, let's prove that math. But Scott makes a great point, because the least happy retirees I know are the ones that retired younger. The most happy people I know retired in more of a gradual way. And so the analogy I'll often use is that of a stock option. So, if you work for a big public company, you might have options, and those options or restricted stock could be as well. Sometimes restricted stock will vest 25% a year over 4 years. Sometimes it's 0, 0, 0, 100. We call that cliff vesting. I've never met anyone that cliff vested their retirement gracefully and happily, meaning you don't go from 75 hours to nothing. If you do, within 3 or 6 months, your spouse, irrespective of who retired, male, female, or what have you, you generally are looking for something else to do. So to me, I think Scott hit the nail on the head. The real question is are you financially independent? I would want your retirement plan to be based on what we call a Monte Carlo simulation, which is thousands of real life simulations over different periods of time, good and bad. So you're not just looking at things from the high or from the low. And if your Monte Carlo says there's a 90% statistical probability that this plan would have worked, then you should start considering it. But to Scott's point precisely, just because you can doesn't mean you want to. I love what I do. People think I'm a kook, but I'm going to retire on August 17, 2037. That'll be 71 in 11 months. I don't have to work to that age. I happen to love what I do, and I'm a little bit of a kook, as I say. So, financial independence and retirement are two different things. I would want her to segregate that question so there's an answer for each. Financial independence as soon as possible. Retirement when it matches up with lifestyle, job satisfaction, do you like your boss, and all those other things.